Let's do the numbers. In a nutshell, in the second quarter, both bonds and stocks moved up substantially. The economy and earnings rebounded. U.S. large companies surged 9%. Small company stocks rose 4%. Stocks overseas increased 4%. Interest rates dropped back down in the quarter, popping prices 2%. Leisure and hospitality opened up as the U.S. COVID-19 vaccination rate approached herd immunity goals. Yet the economy still struggled with supply chain issues and labor market constraints. There are more job openings, 9.2 million, than unemployed, which is 8 million, for a handful of important reasons: childcare, unemployment benefits, permanent retirements early on in the pandemic, and skills mismatches. Stimulus checks, mortgage and rent forbearance, and supplemental unemployment benefits are ending. Inflation is surging as the economy responds to the awakening consumer flush with cash. The Federal Reserve governors label it transitory, which some pros question. Energy rose 9% in June, following 7% in May. But non-energy commodities, think lumber, fell 1% in June after a 7% rise in May. Housing data in April shows prices up 15% over the prior year. No dip in sight. The Federal Reserve System continues to provide stimulus with low interest rates and bond purchases of $120 billion each month for Treasury securities and agency mortgage bonds. U.S. gross domestic profit, GDP, grew 6% in the first quarter and is forecast to grow 11% in the second quarter and end 2021 at 7% overall. That follows 2020's negative 3.5% contraction. Why the good news? Corporate earnings are forecast to grow 64% this quarter from second quarter last year. That's the low point. They're projected to rebound 40% for the entire year. What's happening overseas? Europe just started reopening, but is hard-pressed with a new COVID variant. GDP there is projected to grow 4.5% this year. China, whose economy had reopened earlier, just dropped bank reserve requirements, hoping to boost their flattening growth. Our stock market remains fully valued at 21.5 times forecast earnings. Pros seem split, predicting a bull market ahead of us, or a trending sideways phase, or even an imminent bear market. When the data is messy, when we're in uncharted waters, forecasts are even more unpredictable. We know that bond interest rates are at unprecedented lows. We know that stocks are a decent hedge against inflation based on the past. Economic growth from the other advanced countries is 35%. We are only 25%. So overseas stock markets matter. So we rely on known strategies, diversifying the investment portfolios while incorporating the known changes we see.